A very good morning to you all, ladies and gentlemen, and thank you so much for joining us for the FundRock Hedge Fund webinar. The first of a couple of webinars we're going to host this year, 2025. We had a couple of these sessions unpacking what hedge funds are all about and how various strategies work. And we are continuing with these sessions during 2026. Joining us this morning to moderate the session is Managing Director Pierre Klerk at Apex Investment Consulting SA. Good morning, Pierre. How are you doing?
Good morning, Eugene. Very well, thank you, and thanks for having me again.
Very great to have you with us, and thank you for your time. And Pierre, maybe before I hand over to you to introduce the panel, maybe just a bit of background for our audience. Apex Investment Consulting provides asset consulting services to numerous Cat 1 and Cat 2 intermediaries right across the country. You consult on numerous portfolios, local as well as global, but it also includes a couple of hedge fund strategies or portfolios. So Pierre, thank you very much for joining us. I know you've got almost 3 decades of experience in running multi-managed strategies, and like I mentioned, over the past 3 to 4 years, also hedge fund portfolios. So you do look at hedge funds as well, and really familiar with a lot of these strategies. So the right man for the job this morning. But I'll hand over to you to introduce the panel. Thank you so much.
Thank you very much, Eugene, and good morning to the audience. On the panel this morning, we have Johan Kurtz from Terebinth Capital. We also have Andre Retief from Nexus Investment Partners, that is affiliated to Novare, and the third participant is Jean-Pierre Verster from Protea Capital. As introduction, I thought what I should say is that I think none of us, or very few of us, in our New Year's resolutions would have had at the start of this year that by the middle of March we are going to be experts in the topography of the Strait of Hormuz, or the location of US military bases in the Middle East, or indeed the economics of shooting down $10,000 Shade drones with $200,000 interceptor missiles. But here we are in the middle of March, and there is a war in the Middle East, and there is a lot of news flow. Much of it I see in the last few days happens in the kind of the propaganda social media airwaves as much as it happens kind of physically in the sky over the Middle East. But it's caused market volatility, and it is of a macro nature. So, keeping that in mind, or with that as background, I think it's a very good opportunity, or this month give us a very good opportunity to look into hedge funds and how different hedge funds of different types and different orientations are keeping up in the current environment and what to expect from them. So you will see later, Jean-Pierre has 2 very interesting slides introducing at a very high level the nature of hedge funds and the regulatory regime for hedge funds. And the very first point that he makes is an important one that we've often made in these discussions, and that is that hedge funds is not a homogeneous asset class. You get very aggressive or relatively aggressive hedge funds that should be or can be expected to have a high correlation to the equity market. There's other hedge funds that have almost zero correlation to the equity market. There's fixed income hedge funds. And then there's multi-strategy hedge funds, which some people will argue is supposed to be the most bulletproof of the bulletproof investments. And it's therefore a good time in this month and in these market and macro conditions to dissect that and speak about all these different strategies. And in my pre-discussions with the managers, I mentioned that it will be worthwhile for them to share how their strategies are holding up, but also what to expect from different hedge fund strategies in times like these, and also what the opportunities are and what the tools are that they use to deal with what the market and the macros present them with. So I think we're going to have a very interesting discussion with the three managers. We're going to kick off with Terebinth Capital. So Johan, you're welcome to share your slides.
Good morning, Pierre. You can see my slides, I assume?
Yes, I can.
The drones that you mentioned, I think they're about $30,000 to produce each. But the one point that you mentioned about the multi-strat funds is mainly why I chose a specific topic to talk about the risks involved. We're very close to the London multi-strat funds to observe how they operate in the market, and we see them at these investor roundtables. And what was very interesting in the press over the last couple of weeks is that multi-strat funds that's meant to produce the most stable returns in the hedge fund industry have been taking massive knocks. Most of the funds have given back their full year returns. You can look at any of the kind of big names out there. We're talking about numbers that's sort of for the month to date down 5%. One of the really big multi-strat funds is down, I think, more than 10%. So a very interesting time for us to have a look at what's really going on. So the main driver, obviously, as we all know, is Iran. There's many experts out there. All of a sudden, we all try to also get familiar with what's going on. Sorry, let me just move my slide. So oil prices, that is obviously what we're all talking about. Now, many people out there are fixated on what they hear on the news about what is Brent doing. You know, Brent is $100, $103, and it oscillates around that level. But the one thing that many players fail to realize is Brent is not the most important. Brent, that they refer to as a futures contract. You're not going to fill up your car with paper. You need to look at physical oil. So the global economy, a large part of manufacturing is driven by the Asian markets, and the Asians have to buy physical oil, obviously, to drive the economies. This they buy in Dubai and Oman. And you'll see if you look at the chart, Brent is the dark blue line. So it doesn't look as wild, but if you look at the light blue line, that is the actual physical oil price. So whereas Brent is maybe around $103, that one is up at, well, depends on the day, but call it $155, $150 kind of area, which is a lot more important. Now, what's been going on is you'll see in the afternoon session specifically, you have producers in the US that will come in and sell Brent futures to lock in the oil price for their businesses. And that artificially creates a kind of depressing effect on Brent relative to the other types of fuel. Jet fuel obviously is super important. That is what pays for transport. Flight tickets have gone through the roof already. Some of the early releases in, for example, Mexico inflation that's released every 2 weeks already show a massive jump in air travel, and we can see it across the world. So what's happening? A lot of your global macro funds that's got huge portfolios, that's got multi-asset, they've got long risk positions. They had long equity positions, and at the same time, they also had massive received, or let's call it long bond portfolios. As the Iran attack started unfolding, they macro hedged the portfolio. How do they do this? They went out and they did oil topside structures, which are, let's call it, protective option strategies on oil, or just simply go long oil. They do it via Brent. And we have gotten to a stage now where there's a concept called a VAR shock, which means when the theoretical risk in a portfolio jumps to a certain level, the risk manager walks over to the trading team, taps him on the shoulder, and forces them to degross or de-risk the portfolio. Part of that is you take off your oil hedges, which causes Brent to, let's call it, outperform the other oil forms. Then if I move on to the next slide, let's have a look at what happened in the interest rate market. So Terebinth focus on interest rate markets. If we take, for example, the current scenario and we try to find a template in the past that is similar, we had an oil spike and a market reaction, we can look at the Ukraine invasion 2022. So what we do on the chart on the left-hand side is we rank in dark blue how much the monetary policy expectations expressed by the 2-year interest rate moved in various countries. And then in light blue, we show what it did over a 3-month period in Ukraine. Ukraine's situation was slightly different. South Africa, for example, was already in a hiking cycle. So a lot was already priced, where in the current environment, South Africa priced interest rate cuts. So a very low starting point. So if you look at that slide, you'll see, for example, on the far right, South Africa is one of the markets that changed the pricing of central bank reaction function the most. And it's in good company. You know, it's got Poland, Czech, and Hungary with a similar kind of performance. And the reason for that is what I referred to earlier, VAR shocks. When there's unwinding, it takes place in portfolios that holds all these instruments, and they have to unwind everything. It's just everyone get out the room. And so your London kind of platform hedge funds have caused quite a bit of co-movement in assets that sometimes don't really have all that much correlation. So how does the oil price filter through to the world? You'll see that it's pretty straightforward. Oil price goes up, and there's a lot of byproducts from oil, fuel, fertilizer, plastics, etc., that goes up as well. So what we do at Terebinth, we monitor all kinds of markets that maybe others don't monitor by staring at the Bloomberg. We look at onshore China commodities. About most days or many days, those are all limits up. And we're talking about things like polyester. So you can imagine how this spills over to other markets. Your synthetic fabrics shoots up. So you've got to start, you're going to start seeing demand for other competing fabrics, let's say cotton, and cotton will start moving up. And so this whole effect spills over from one market to the next. And all of a sudden, when fertilizer goes up, the farmer in Robertson is going to pay a lot more to grow his tomatoes. And he's going to pay a lot more in fuel to transport it to Food Lovers Market in Willowbridge. And the prices will adjust. So what you see now is that with all of that, inflation expectations start rising. From that, normal people in the guy in the street goes out and he will demand higher wages. And all of a sudden, the monetary policy has to respond, because now you've got second round effects coming through on inflation. There's a risk that inflation expectations will de-anchor longer term, and it will derail the inflation targeting regime. So all of a sudden, the central bank is put in a corner, and they have to balance up. What do I do? Do I fight inflation? Do I try to protect growth? And with an inflation targeting central bank like South Africa, it's always first you fight inflation. In the past, we have seen many regimes where we've had a similar situation with the growth risk, but inflation is going higher, and the central bank actually first acts on inflation. So we have to be very careful in how to position portfolios to protect our investors' capital. So briefly, if you look at the markets, I think most in the audience are very familiar that equity markets took an absolute beating. South Africa, one of the worst. Bond yields shot up once again. South Africa, one of the higher ones on there, or larger moves on the league table. And on currencies, dollar went bid. That is the natural hedge. So other currencies have struggled. The one line that a lot of people will probably mention is what Warren Buffett said: only when the tide goes out do you discover who's been swimming naked. And I think now that beta or long only funds will take a lot of pain over this period, the investor would look towards hedge funds to provide that kind of protection. But now the important question is, did they provide the protection? And I know that we will all be judged on that. During 2025, when beta or long only assets performed very well, many hedge funds would have been very tempted to start shifting towards more beta heavy strategies. And I think end of this month, the numbers will tell the story. Quickly on our portfolio, I'm not going to run through this really. We are here to seek absolute return and to preserve capital. We also try to compress downside volatility. Our target is straightforward. It is cash plus 5 over a 36-month rolling period. However, we do obviously strive to provide that in the short term as well. You'll probably recognize our CIO there on the front of the boat. How do we do this? How do we navigate the turbulent waters of the strait? Well, our investment process is, as our CIO always says, the guiding North Star. So in a very collaborative and team approach, we construct a kind of forecast of asset prices in over a 12-month horizon. However, asset prices doesn't move from point A to point B in a straight line, and that is where we extract alpha. When the market offers opportunities to harvest the alpha, we do that, but we also continually and tactically protect the downside with very detailed risk management process. Our strategy has got various pillars to it. The one that I want to focus on now quickly is the tactical, because that is where we see risk management is fitting in. If we look at the various risks, once again, the key one at the moment, the way that we're looking at the market, is market risk. We've got massive volatility, and that is what we need to manage and control. In our portfolio, in the mandate, we have hard stops, as we call it, written in. In other words, if the portfolio loses 2% during the month, we halve the risk. If it loses 3%, we cut all the risk. 100% of the risk will be gone. We will take let's call it a short trading break, reassess, do our analysis, introspection, and come back fighting with a clean slate again. So how do we measure risk? We look at value at risk. I'm not going to go into detail on this, but the one that your regulations are centered around is a historical simulation. That is the so-called 21-day VAR. That is set by the regulator at 20% of portfolio. That for us is about mandate compliance. We have got our own models doing this as well, but we have got a third party that reports on that. But what's important for us as a trading tool and a sizing tool in the portfolio is a parametric VAR, or the so-called covariance VAR. Quite simply put, this gives us a good idea of what our daily profit and loss swing should be, and whether the portfolio is hiding any correlated positions that you can't detect by simply eyeballing the portfolio. You need to do very detailed analysis. So when we enter a transaction or a trade, the sizing is not based on gut feel. It is based on a very detailed scientific process or mathematical process, and that we combine also with our own skill, and I could call it a form of art. So how does a VAR shock happen? Now that we spoke about the platform funds earlier. In London specifically, there's many of these platform funds. Now, each of them have hundreds of different trading teams. And the idea with that is they've got diverse ideas, different trading styles, and they should, in theory, act as a hedge to one another. If you add up the capital of each trading team, it typically adds up to about 4 times AUM. So it's very leveraged. And within the trading teams, they use leverage as well. The fund aims to make money 55% of the time, and the model works very well in normal markets. Guess what? It's not a normal market. So all of a sudden, you have got a shock event. Let's say oil price spikes. Volatility goes a lot higher, so your mathematical measure of portfolio risk will shoot up. Plus correlation spike. All of a sudden, things that was previously not correlated at all becomes very correlated. You know, you see South African interest rates trading 1-for-1 with Czech, Poland, and Hungary. That is unusual, and your portfolio measure VAR will jump. Your trading team in London will have a value at risk breach. The risk manager walks over, taps them on the shoulder, and forces them to stop loss. And all of a sudden, that has market impact, and so it snowballs from one market to the next. That is what's called a VAR shock, and what you're pretty much seeing in the markets right now. So if we look at a snapshot of a theoretical Terebinth portfolio where we're positioned with a value at risk, the 1-day VAR of 1%, meaning that we shouldn't lose more than 1% of the portfolio on a given day, which implies regulatory VARs about, let's say, just under 5%, which is a quarter of the regulatory limit. What this means to us is our portfolio over a 1-year period, in theory, should have a volatility of profit and loss of $10 million. So we can use this to try to determine, is the sizing of the portfolio correct for us to achieve the mandate goals? What we need for that is we need to understand what is the Sharpe ratio that we generate. In other words, you know, how skilled are we in what we're doing? Our historic Sharpe ratio varies over time. Most recently, you may find it's 1 1/4. So if it's 1 1/4, we can actually mathematically determine that the portfolio with the current risk is likely, if our skill holds up, to produce alpha or excess return over benchmark of close to 9%. However, if we are trading badly and we just, you know, don't see any opportunities that offers the kind of returns that we need, and we produce a Sharpe of 0.5, however, then all of a sudden we will produce an alpha that is a lot less, that is only 3.5. So we've got to be very careful in how we position the portfolio and how we backtest it. If we look for a regime that's similar to the kind of Iran attack, we will look at Ukraine and we'll say, okay, we want to construct a portfolio that would have performed very well during the Ukraine scenario. And that's what I show here. We take the current portfolio or the intended portfolio and we backtest it to Ukraine, which is that first green arrow. And it shows that this current portfolio, if Ukraine happened again, would have performed extremely well. So based on that, we can make the decision, okay, the current portfolio is suitable for the current regime. Just a quick sample of, let's say, daily returns. If you look at the All Bond Index, for example, and you compare it to our portfolio, percentage positive days is pretty similar year to date, but the kind of numbers does make Allbe look a lot better because most of the drawdowns only happened in the last 3 weeks. If you look at the average daily return, our portfolio did about the same as the Allbe, the average positive day. However, the difference comes in with the average negative day. The average negative day in the portfolio, because you're a hedge fund and you're able to protect the downside, is a lot less than that of the All Bond Index. So what we really look at is, what is our ratio between the average up and average down day, and we obviously want that to exceed the Allbe because that is what we're trying to achieve. And in this sample, for example, we were successful. If you go further back to last year, we would have been unsuccessful because last year was very, let's call it beta heavy, where long only markets performed very well and hedge funds, unless they swung to long only strategy, would have underperformed. In the long term, on the portfolio, we try to also see, do we capture upside and what happens during downside? And this is a slide we always show in our marketing material. In a equity bull market, in up periods, the hedge fund would have done positive months 74 times out of the 90 periods. And on the All Bond had 98 up periods, and we participated 86 of those. So a very high participation rates in bull markets. But the most important, as a hedge fund investor, you want to know what happens when market goes bad. The next slide shows that in bear markets, the hedge fund participated only 15 of the all share bear markets and only 17 of the Allbe bear markets. Long-term returns, obviously you had the equity market performing super well last year, so it has overtaken our hedge fund since inception. However, our hedge fund is an interest rate hedge fund, so maybe the All Bond is more fair comparison. However, I would say that after March, we may see this chart revert back a little bit. Equity market obviously took a sizable beating over the last few weeks. We're hoping that it's not going to continue, but it is an uncertain environment. And as a hedge fund, we have to remain very nimble, very quick on our feet, tactical, preserve capital, and limit the downside. Thank you very much.
Thank you, Johan. That was very interesting with a lot of potentially quite technical aspects, I suppose. So I'd like to ask some questions, but I obviously don't want to kind of split hairs about things like the assumptions around using a normal distribution in the calculation of the VAR and so forth and so forth. Let's leave that for a different day. But to make it more practical, maybe a retail investor can't calculate a VAR easily by himself. So if a retail investor were to look at your fund and want to try and get a handle on the volatility of the fund, for example, or the risk-adjusted return, what would you say the primary risk measure is in a very kind of, let's call it retail or practical sense to consider? Is it straight volatility? Is it drawdowns? How can retail investors look at the risk of the fund?
I think a lot of the information will be available on the fact sheets of all the different hedge funds. So you don't really need to be a math genius to figure out the numbers. So the one thing that you would look for is a Sharpe ratio. So you're looking at the excess return divided by the volatility of the fund, because that sort of combines both the return aspect and also the volatility. Simply eyeball the table of hedge fund returns and put it side by side with your equity unit trust or your bond unit trust, and have a look at the two together. And in a certain month, like let's say this month, if the all bond and the all share index took a sharp nosedive in March, have a look at the fact sheets of the various hedge funds and see who else took a nosedive. If a hedge fund correlated highly with these markets, then the hedge fund is not offering you the kind of hedge that you want from your portfolio. You as the allocator, being retail as well, you as the allocator make the decision. Do I want beta? And do I want protection? If you want beta, you will allocate to let's say the Terebinth equity fund. If you want protection, you will allocate to the hedge fund. And the whole idea is you've got to spread your investments, make sure you're positioned for all outcomes. You have a bit of everything. The last thing you want is to have all your eggs in one basket.
Thank you. I agree with that, absolutely. Maybe a question on your stop losses that you talked about. You mentioned a 2% off the table effectively. Well, when you reach the 2%, 50% off the table, and then 100% at 3%. Now, I understood that to be at the portfolio level, which sounds kind of very, very solid and cautious in a sense, or certainly so. So the question is, are there also stop loss limits on individual kind of underlying strategies in the fund or individual instruments, which are maybe less kind of dramatic, so to speak?
Yes. On individual instruments, it is not written into any kind of policy. Portfolio level, it's written into the policy. However, per strategy and instrument, it is the individual portfolio manager and also the team. So if I have a strategy that I have on the portfolio and all of a sudden it's just not working, it loses money on a daily basis, then my colleagues will approach me and say, look, how certain are you about the strategy? I know we discussed it. We will go through the pros and cons. And typically, as I always say, if my profit and loss is red, it is screaming at me that I'm wrong. So portfolio managers do cut out of strategies quite quickly. And that is where the benefit of being tactical comes in. If you're wrong, cut it, move on to the next strategy. It is pretty straightforward. We stop loss a lot. I mean, our turnover in the market is pretty high. And that is because we're nimble and tactical and we don't get married to positions.
Thank you. Another question for pure interest sake, but I wondered about it when I went through the slides last night, because I actually don't know what the answer is. And my question is, the regulatory VaR limit, how does that actually work in practice in terms of the response of the regulator? Because obviously it's an ex-post calculation, I suppose, that are monitored by the regulator presumably or submitted. So are there any practical examples in South Africa where the regulator have actually kind of called out hedge funds about their breaches of risk limits? Can retail investors have comfort that the regulatory framework actually holds?
We haven't seen it on our side, but I'm sure that is exactly what will happen. The administrators get the risk reports from the third-party risk monitoring company. They are very conservative in their calculation. So they report it to the administrator, and the administrator, I think, will first reach out to the portfolio if they're in breach of the limits, and it will get to the regulator. I haven't seen the practical workings of it. Fortunately, I would not like to see it. Look, we do model the kind of historical simulation as well, which the third party uses. But it's not very practical for us. It's computing very heavy. So my computer will fall over if I try to run the model more than once. That's why we use the kind of simplified variance covariance VaR. That is quick and easy, and it is super accurate in predicting daily moves. Plus, I can overcome the limitation of the exclusion of, for example, the COVID era by simply adjusting my sample period to reflect the volatility over a regime that is suitable or that is comparable to the current regime. For example, at the moment, whereas we do the variance covariance VaR over a 250-day period usually to give a sense of daily P&L swings and potential annual profitability, we shorten it a lot. So we do it over various periods. And at the moment we're running at like a 21-day because all the events have happened in the last few weeks, and that's most relevant. So my risk when I do that shoots up quite a lot, my calculated risk, and so that helps you to size your portfolio. So what you find, let's say the London guys, right? They breached VAR limits not because they changed positions, just simply because correlation volatility picked up, and all of a sudden you're in breach and you have to cut. We stay far away from our VAR limit. The VAR limit is a regulatory one is 20%. I think our third party calculates ours at the moment at something like 6%. So even with a high volatility, we leave a lot of space for further volatility spikes. We don't want to get to a situation where we breach.
Thank you. Last question that came in from the audience, and I'm sure the information is on the fact sheet, but you're welcome to answer it. What's the pricing structure of your macro fixed income hedge fund?
Ooh, now you're asking the wrong guy. I press buy and sell buttons.
Okay. No, let's leave it there. I'm sure.
It's 1% management fee, and the performance fee I think is 15%. But the 15% is only charged after you've made the 1% as well. So it's a step fee plus management fee you've got to beat, and then it's 15% performance fee beyond that. But there's various fee classes, so it could vary from one investor type to another. The South African market is super competitive in the global context. So I can tell you that most of the London funds are on 2 and 20 fee structures, and the new development over the last few years is a so-called pass-through fee structure, where investors pay just about everything. They pay a management fee, and then sign-on bonuses for PMs. Cost of running the company. There's even cases where the artwork in the office was charged to investors. So, the international arena has gone a little bit crazy. South Africa, I think, offers a very good value proposition for the kind of skill and the return profiles that you get.
Good. Thank you for that. Let's hope that structure don't come to South Africa soon.
I was hoping it would, but there's no chance.
In the interest of investors. Thank you. Thank you very much.
Thank you for the opportunity.
We're going to move on to Andre from Nexus Investment Partners. You're welcome to share your slides and to kick off.
Thanks, everyone, and thank you for FundRock for setting this up. As you can see on my front cover, we have the bull there versus Donald Trump. I've been kind of through New York the last week and a half on my way to honeymoon, and the bull looked a bit more tired. I went to go and visit him. He doesn't look as strong. That's probably a 2025 bull that. But yeah, in short, we're Nexus, and we're in partnership with Novare Investments. We still waiting for our Cat 2A license, so we're a juristic rep on Nexus. And what Nexus does in a whole is they're a single manager and the active manager for the Novare group. Just for the sake of time, everyone's very welcome just to read through this. The strategies that we have is just a long short, a balanced, a high growth, and a global equity. And obviously today we'll touch on kind of hedge funds and the opportunities we see in the market for a long short hedge fund. The first opportunity I would like to touch on is the investment case for rare earth minerals. A lot has happened this last few weeks, like Pierre alluded to, is everyone is we know everything about oil and the Strait of Hormuz all of a sudden, and about a few months ago, we knew everything about rare earth minerals. We think rare earth minerals and critical minerals is a theme to stay for kind of, it has some longevity, and the reasons we say that, we think it's quite obvious. I mean, it's everywhere and almost nobody knew about it up until a few months ago. And the scary thing is China controls everything. And what a lot of people don't know, it's in EVs, it's in supply chains, it's in tech, it's in defense, it's everywhere. And the bottleneck at the moment is China as kind of the reins over where, what, and when with rare earth minerals. So why are we saying rare earth minerals? And you can throw critical minerals under that as well. China owns most of the mining, production, and refining capabilities. And we think when owning some of these assets, it can be a hedge against the US and China relationship. We saw yesterday night that Donald Trump is going to visit China now next month, which is kind of a positive for the relationship. We obviously hoping it's deteriorating a bit. I mean, that's better for our positions. As I've mentioned, rare earth is being used in critical defense and semiconductors. And actually, people don't know it. It's in abundance. It's almost like copper. It's just quite difficult to get out. It's in funny locations, but I mean, the minerals itself, the 17 minerals itself isn't the problem. The refining is the bottleneck there. And then we said that US is very aggressive in diversifying its risks away from China. We saw a $12 billion critical mineral fund. We are almost weekly seeing the US government investing into these companies and kind of putting a price floor under the companies, which we think is very interesting for the next 3 years, and we think is a very interesting corporate action play for us. When we hold this stuff, we obviously think about what's the correlation, because there are some risks in this stuff in the short term. Obviously, it's still risky assets. We think over the 1 and 3 years, you can kind of, it's almost a no-brainer. But obviously, as risks get sold off, these stuff gets sold off as well. So we especially look at a basket of these versus our local stocks. It has about a 40% correlation to the JSE All Share Index, and almost about a 0% correlation versus our local financials, which makes sense. So if we want to add risk and we don't want to add domestic risk, it makes sense to add a bit of those. We definitely not correlated to what happens with our political landscape locally. On the equity return basis from kind of these baskets, we saw the initial wave of optimism, where we said investors bought first and they kind of asked question later. You can see that how the China Rare Earth Index did. You can see the spot price in green for some of these metals, and the World Rare Earth ex-China has all actually outperformed the MSCI World in kind of the last year. So we do believe that the next phase would be driven more by stock selection and not that initial phase, almost the AI phase that we saw here a year and a half ago, where you kind of buy everything and ask questions later. We think we're that cross section where you need to have the skills and the people to evaluate what's going to win in the next 3 years. We think there's going to be 2 or 3 winners on the refinery side, and we kind of want to be in 1 or 2 of those. On my point that earlier, we said that data centers is very big, but what the world probably doesn't know is data center and defense needs critical minerals and rare earth. So we said that if you long defense and data centers, you are properly long rare earth elements as a second derivative. I mean, as Pierre mentioned, are they bombing $1 million of missiles just to get a few $1,000s of drones down? All of these missiles, you can see on the bottom left slide, all of them, they need rare earth elements. And the problem is sourcing it. And we saw the price of these rare earth element baskets going up exponentially because there's such a big demand for it. We said that the Trump administration frequently launches initiatives and funds to support these sectors, and we think that's going to continue. We actually think it's only just starting to pick up. We think that's the beginning. So we think, besides for earnings growth, we think, as I've mentioned, it's a proper corporate action play. And we said data centers needs defense and energy. We're at a situation where we think hyperscalers will probably push for increased security guarantees. The Middle East will most likely increase defense spending, leading to an increase in demand for rare earth elements. We had a situation globally where the Middle East 2 years ago thought that the US can completely protect them. That is obviously not the story, as of countries like UAE has almost caught the same amount of missiles than Israel caught just for being affiliated. So we think there'll be a lot of spend by the Middle East companies on stuff like defense in the next 3 years. And we think ultimately oil will be in a better place in 3 to 5 years. We think Saudi will diversify their pipeline, their alternative pipelines even more. So we think that in the short term, the risks are obviously big. We think in the longer term, we'll be better off. And then we'll say data centers will need an enormous amount of energy, and it's probably good to look out for alternatives such as uranium. On your right-hand side, just a very interesting slide showing that the annual construction spending on data centers is now actually more than the spend on offices. On your left-hand side, you can see that even Amazon's data centers has been attacked in the Middle East region, where probably a year ago, and if you ask them, they'll probably would have said it's one of the safer places to be. Just on the oil shock, we think the world is probably too fragile for another oil shock. I mean, CPI is still high globally. In the blue line on the top side, you can see the Brent movement now versus the Brent movement on 2022, where there was also a proper shock. So it is quite extreme. And me and Johan should have probably sat together, because the left-hand slide is the same as he put up, the left-hand graph. But Asia and US will definitely feel most of the pain. Europe has a massive problem, and I think the rest of the world is decoupled from, as Johan mentioned, as what Brent is doing and WTI is doing in the US, because it's worth noting that the US is the biggest producer of oil, and EU is a big importer. I think it was the Philippines yesterday who said they're importing 98% of the oil, and they currently in a state of emergency due to low oil reserves. And this slide just says, never underestimate your enemy. We think Donald Trump underestimated Iran. We think after Venezuela, there was some overconfidence bias of just snatching the leader and kind of moving on. On the left-hand side, you can see all the sites there that's been struck since February 28. And on the right-hand side, you can see there's just so many oil terminals. That's why they call it the Gulf of Oil. On your left-hand side, you can see left to Saudi, you can see the alternative pipeline going through there. They're currently at about 4 million barrels. They want to go up to 5 million barrels, but that's not enough, as mentioned on this. We think that Russia is a major beneficiary of this war. You can see on the right-hand bottom slide, graph, you can see Russia is just pumping oil. They're making money out of this. I saw this morning as well that the graph has even gone up even more from here. So Russia definitely a major beneficiary of this oil, and we think that Iran is obviously also not doing financially bad in terms of oil. China still taking the oil. We said, and this is a slide we made last week, and we said it can get a lot more worse from here. And this was before they actually said that they will attack the water desalination plants in the Middle East. So after obviously Donald Trump threatened, gave some big threats, they came about their power plants. They came back and said, we'll attack all the desalination plants in the region. We think if a scenario has to play out like that, we will immediately be in a global recession. Most of these countries use between 70 to 80 to 90% of their water come from desalination plants. So they won't have any water. That means no production, no oil production, and you'll automatically see them going into recession and the globe as well. So we see that as worst case scenario, and we think Donald Trump knows that. Just out of a tanker activity, we track these daily from the satellite images. On your left is just a zoomed out one. On your right, you can see it's more zoomed in. Tanker activity is probably as of yesterday, at about 7 or 8 tankers a day, down from 140 or 120 a day. And we believe that China is still in a relative good space from these. But I mean, not just China, Japan is allowed to move tankers through there. South Africa is also allowed to move tankers through there. And the comments came up with, what boats are we going to do it? Most likely a canoe or something like that. But I mean, we can hopefully, if there's some initiative, we can rent some boats and get some oil from them. On Johan's point as well, I mean, interest rates is in a very difficult spot at the moment. You can see on your left-hand side, there was a lot of decrease in rates for the beginning of the year and the most of last year as well. On the right-hand side, the US curve is actually starting to price in some rate hikes, which is problematic because we've moved from kind of 2 rate cuts to 1 rate, almost to 50% for another rate hike. So that prices out a lot in your bond curve and your risk curve across your equity and your bonds. This is a very interesting graph for me. So what a break-even curve says is what the market is pricing in terms of expected forward inflation. On a 1 year, the market is pricing in the US almost a 5.3% forward inflation. And on the 5 year, they're only pricing in a 2%. So the market is telling us that this would be sorted in the next year, the inflation problem, if inflation persists from these. I'm not sure if this carries on for another 3 to 6 months, that's going to be the case. Hopefully Donald Trump can get it sorted relatively quickly. Moving to private credit, we also made the slides last week, and we said there's some problems. Blue Owl saw its worst monthly ever return in February, and we think that this is problematic. I actually saw that Apollo 2 days ago also got an 11% redemption in some of the funds, and we think some of the reason for this is software. Obviously, software is changing the way all of these VCs, tech VCs are running, and software has also been murdered year to date on an equity basis. We just want to caution people that on software, just be selective on your exposure. Just don't go and say we're buying software because we're buying software. You can see on your right-hand side that the actual percentage that global funds and bonds are invested into tech and software is quite material. So I think if you look at kind of private credit funds and those type of stuff, just be aware and just look out for what's in it. We've mentioned China. We said that China is welcome to transfer through the strait. China also has an abundance of oil resource reserves for now. China will definitely continue to stimulate the economy further this year. We think it's a relative safe space, although they're obviously still struggling to stimulate consumption. They still have the property problem. But on the right chart, it's a very interesting chart, seeing that the R&D that China is spending relative to their GDP is just moving up year over year. And we heard the comments from Jensen Wan, Nvidia, and all of those places saying that China is almost at the US level, or probably in front of the US level in terms of innovation. We think that's one to look out for. Obviously, the question on everyone's mind is gold has done nothing this year after kind of this Iran war. People got carried out. Most of the time, you would think in a geopolitical event, gold will help you. We think there's been a lot of deleveraging, and we've seen a lot of steep sell-off due to the US bond curve moving upwards, showing us that it's still a opportunity cost trade. We think that the long-term drivers are still intact. Usually, if you look historically, after this massive sell-off in a type of oil inflationary shock, it's not a bad idea to revisit your gold position, kind of look to add more. We think that government debt is horrendous globally, so we think those type of drivers is not going to stop it. But I mean, in the short interim term, people will use the most liquid assets to sell down and kind of reposition their portfolios. We are more focused in this presentation on what opportunities may come from Iran war. So the first one we're seeing and we're monitoring is the UAE ETF, is the Emirates ETF. It's the Emirates has been bombed due to aligning themselves with the US. They will be the first to recover, we said. And we said the drawdown has been extreme, but we still expect a bit of more drawdown first before we see a bottom. I mean, we feel actually bad for them. They've received so many bombs just by aligning themselves with Trump. You saw actually that the US has held up, the US indexes has held up quite nicely relative to the globe. So if you think that we had peak negativity, we don't think this is a bad trade to look at. We think another trade that's going to get hammered in the short term, but it's a great trade to get into after we think we had peak negativity, is the US airliners, and not specifically the airliners that are hedged for fuel prices. You want to get into the unhedged ones. So you can especially see in the index, there's a lot of airliners that held up quite nicely, and most likely the reason for that is they are hedged. The United Airlines are not one of them. Most of their book is unhedged and they got carried out, but we expect this as we get past peak negativity to actually unwind a bit to the upside. So we said if this is a short war, we gave some scenarios. We said add to Japan, they're also a major oil importer. You can see they got smacked as well. We still like Brazil from the EM market. It's difficult to say take the whole EM market. Everyone says EM, but the EM index is a lot of South Korean and memory stocks in there. So you need to take a view on the memory stocks on stuff like Samsung, SK Hynix, and those type of stuff. So we prefer to be more specific. So we said Brazil. We like Discovery. We think that was brilliant results. We think they're firing on all cylinders. the bank is doing quite well. We like Sun. We like Sun International. They came out with results. It was decent. Their dividend yield is about 9%. And we think if this is a short war, you want to get back into gold. We think that this was just a deleveraging and a liquidity event. You probably want to jump in there and lock in some gains. And we said China is also a relative safe space, and that is for if it's a short war and it's a long war. If this is a prolonged war, we short EM there. We short the whole EM index. We short the US 10-year. Inflation will creep in. We'll see inflation problem, and you would want to be long the US dollar, especially as a South African investor. And just as a last point, we said we have about 8% of the hedge fund in rare earth element companies. We're looking for the winners plus corporate actions. We're expecting that to play out over kind of the next 3 to 6 months in terms of corporate actions. Just as key takeaways, the longer the Iran conflict continues, the higher the chances of a sustained CPI increase. It's obviously negative for risk assets. The Trump administration can only absorb a limited amount of economic pain before midterm elections. We forget that end of the year is midterm elections, and we don't think that where Trump initially campaigned on he's against wars and getting everyone in wars, we don't think that you can send tens of thousands of US troops to their death with the kind of trajectory that it's going to take if you send your warships to there. We think Iran is at a place where they have nothing to lose, and we're surprised by the hardballing that they're giving. You saw over this last day or so that Donald Trump said, listen, let's do a deal, and each time they came back and said, no, listen, we'll decide when we do a deal. And I said that a contained war is generally good for the GDP of a country in the short term. Look at the spending. They initially spent $50 billion, the US. They asked for another $200 billion. I believe they even asked for more money this week. So, I mean, there's some proper spend happening in there. And just as a last point, even if the war has to stop tomorrow, there's still going to be a new floor under oil and gas and helium in the short term. Because, I mean, you can't replace stuff like Qatar's LNG fields overnight. It usually takes a year or two. So there will be a kind of a lag term there. But I just also want to caution that the stock market bottoms long before we stop being negative. And then I just added at the bottom, is this another target trade? And I did this slide on Saturday, and it looks like Donald Trump is trying to get out of there, and I don't know if Iran is going to let him, but he's starting to understand the long-term effects of a sustained war in the Middle East. Just as a last slide, we just want to say what an hedge fund is. We say a hedge fund is, if you look at your investments, it's a toolkit, and we say with the long only fund, and there's nothing wrong with it, and it works in the long term, but you kind of have only one or two key tools. Your tool is maybe long only, and maybe your manco will allow you to hedge a bit of currency or whatever it is. When a hedge fund, you have multiple tools in your toolkit. You can go long, you can go short, you can do pair trades. A pair trade is where you let's say you like Anglo, you long Anglo, but you don't like BHP, you short BHP, so you're hoping that the spread goes up in there. So at a sector, you're still neutral. Currency pair trade. So there's a lot more to do in a hedge fund in terms of risk control there's a lot more you're supposed to can do in a hedge fund than a long only. It's just how effectively do you deploy it. Yeah, thank you for everyone's time. I hope it kind of helped in terms of what opportunities we think can be there in the next week or two. And then just as a last slide, it's just compliance that I don't know a lot about.
Thank you, Andre. Some very interesting slides and some very interesting angles of how you look at the stuff. I think we'll ask you a few questions at the end. I'd like to move over to John Pierre immediately.
Great, thanks. Morning, Pierre. Morning, everyone. It's great to be on this webinar. I just had a look. We have more than 250 people on the webinar. So it's good to see the interest in hedge funds. And hopefully I can tell you a bit more about not only hedge funds in general, but also Protea's hedge fund offering. I'll touch on the recent market turmoil, but I'll take a different perspective to what Andre and Johan have done. I'm not going to talk macroeconomics or the details of what's happening in the market. I'm going to touch on how hedge funds have performed during the recent market turmoil. And then I'll also touch on how to invest. It's very important for retail hedge funds that financial advisors and investors understand how they can access these strategies, and I'll contact details at the end. So Pierre did mention this slide earlier in his introduction, where I make the point that hedge funds are not homogeneous. You have equity hedge funds, you have fixed income hedge funds, multi-strategy hedge funds, market neutral, all kinds of different strategies. And they have different objectives and different risk profiles. You get anything from quite aggressive hedge funds to very conservative hedge funds. So if you say you've got a hedge fund allocation or a hedge fund investment, it doesn't necessarily mean a specific definition. It could be that you are trying to enhance your returns in a portfolio, or it could mean that you are diversifying your risk in the portfolio. And these return enhancing hedge funds versus risk diversifying hedge funds will give you quite a different return profile when you compare it to a benchmark or to the market. So you need to decide which one of these two broad risk groups do you want. And sometimes it's a good idea to have exposure to both. So if you combine some risk enhancing type hedge funds with some, return enhancing hedge funds with some risk diversifying hedge funds, you get this wonderful thing called the free lunch in investing, and that is risk diversification. And through this diversification, you have a smoother return profile through some higher return funds and some risk diversifying funds. And that can really benefit your portfolio, specifically in post-retirement portfolios when you have sequence of return risk, but also in non-compulsory money. We've seen that in our funds as well, that unfortunately, the biggest outflows we get is after markets have had a bad period. And the biggest inflows we get is after markets have had a strong period. And that speaks to the pro-cyclicality of investment decision-making by the typical retail investor. And normally that means if you are invested in a traditional fund, you put money in at the worst time near the top and you take money out at the worst time near the bottom. And part of a hedge fund's job is to protect you from yourself. It's to make the journey smoother while still participating in the upside. And in that way, try and stop you from disinvesting at the worst time, because there's not a deep drawdown if you have a significant hedge fund allocation. So often hedge funds are perceived as being very risky. In international markets, some people have said hedge fund managers are cowboys. It might be the case offshore, but it's very different in South Africa. Hedge funds are strictly regulated. And I have a slide about the regulations that will come up. I'll touch more on that when we get to that slide. The other thing about hedge funds is they are associated with high fees. We spoke earlier about the type of pods or platform multi-strategy hedge funds with pass-through fees. And the fees there can get absolutely eye-watering. And a lot of people say, but are these investors mad? Why do they invest in these hedge funds that charge? And some of those multi-strategy funds would charge between 3 and 5% basic fee, plus a performance fee that could be 30%. And people say, but people are mad to invest in these funds. But still, these funds have attracted billions and billions of dollars from the most sophisticated investors, including sovereign wealth funds. So why do people do that? Are the sovereign wealth funds stupid? Are they dumb? No. What they do is they look at the after fee return. And the irony when it comes to hedge funds is the funds with the highest fees are the funds that have performed the best. That's why they have the highest fees, and particularly quite high performance fees. While the funds that maybe give you less good returns have got lower fees. So instead of saying you are looking for the hedge fund with the lowest fees, what has actually worked historically is to look for the hedge funds with the highest fees, because the highest fees implies the highest after fee return as well. So it's an interesting way to think about it. It's not the traditional way people think about it, because obviously the passive industry has told us all fees are very important, all other things being equal, meaning they always make the assumption that your pre-fee return is the same across funds. And that is the problem. That is not the correct assumption to make. The whole point about a hedge fund having more tools at its disposal is to generate a higher before fee return, ask an above average fee, and still give an above average return net of fees to the end investor. So fees can only be high in hedge funds if there's high performance fees, which means that the ultimate investor has also benefited from the high before fee return. So I've touched on the role of hedge funds in a portfolio. Let me reiterate this. Hedge funds are a bi-directional investment strategy. So you can profit both from rising and falling share prices. You can go long and you can go short. And they have additional tools to manage risk, primarily the tool of shorting, leading to a differentiated source of return. So even a fund which gives you the same return over a long period of time, when you compare it to a benchmark, it still has value if the source of that return is differentiated, meaning that when your benchmark or whatever you're comparing a hedge fund to goes down, this hedge fund actually stays level or goes up. Then, even for the same return over time, the hedge fund has delivered what it should, being a risk diversifier. So I spoke about return enhancers versus risk diversifiers. The return enhancers are typically your hedge funds that are looking for superior risk-adjusted returns via a higher net return over the long term. So they have high correlation to markets. They are benchmark aware. And the strategy you can refer to, which is most common when we talk about return enhancing strategies, is an active extension strategy. And all that means is the fund is actually a long-only fund. And then you extend the long-only with a hedge fund portion in the portfolio so that the correlation is very high. But you've now extended the long book, maybe from 100% to 130%, and you have 30% short positions. So there's still a net 100% equity exposure within the hedge fund. It will have similar volatility to the market. But what that type of hedge fund manager tries to do is not to manage volatility. It will be quite a volatile fund, but to still give you a higher net return for the same volatility as that benchmark. So they aim to do better in up markets, but no worse in down markets. That is what an active extension strategy is all about. High net exposure, aggressive equity long short, and performance fees are normally charged relative to that benchmark. The other broad category of hedge funds, and this is the type of hedge funds that Protea manages, so our philosophy is more towards risk diversifiers, and that is that you try to generate a superior risk-adjusted return, not necessarily via a higher return than a passive index, but via lower volatility. So the aim is to give you, call it a similar return to a benchmark, but at lower volatility, a smoother ride, lower correlation to markets. And to do that, normally these types of managers are benchmark agnostic. Their portfolios look very different to what a passive benchmark would. And they aim to limit deep drawdowns, but still participate in up markets. So you want less of the downside, more of the upside. That is what a risk diversifying hedge fund does. And you get anything in risk diversifying hedge funds from low net equity exposure, that's your market neutral type hedge funds, to medium equity exposure in the equity long short space, and anything in between. Because these funds try to limit drawdowns, and they are benchmark agnostic, and the volatility profile is very different to a passive index. They normally do not charge performance fees relative to a benchmark, but relative to an absolute hurdle, whether it's a STEFI rate or a CPI rate. These performance fees are normally relative to an absolute hurdle. A quick regulatory summary. Hedge funds are a type of collective investment vehicle. It's regulated by CISCA, the Collective Investment Scheme Control Act, and board notices, which the FSCA releases to clarify some details regarding the rules. Retail hedge funds have a 200% gross exposure limit when you follow the commitment approach. What that means is for every 100 Rand of capital in the retail hedge fund, the hedge fund manager can maximum take 200 Rand of exposure, say 140 Rand long and 60 Rand short. 140 plus 60 equals 200. That's the maximum gross exposure you can take. Or if you're a fixed income manager, some multi-strategy managers, you're also allowed to take the value at risk approach. Johan spoke about that earlier. And there, the regulatory limit is 20% value at risk at a 99% confidence interval. And again, that's more appropriate for fixed income hedge funds. You get qualified investor hedge funds and retail investor hedge funds. The QIFs, as we call them, normally have a R1 million minimum, less strict limits, and they're more for sophisticated investors. You might have seen a recent CISA stats that says at the end of 2025, for the first time, there's now more money in retail hedge funds than there is in qualified investor hedge funds. If you manage some Regulation 28 compliance portfolios, Reg 28 allows for a 10% allocation to hedge funds with a 2.5% limit per fund or a 5% limit per hedge fund of funds. So unfortunately, it's still a very low limit. You can only have 10% in Regulation 28 compliant portfolios, but specifically in post-retirement portfolios where sequence of return risk is very important, we've seen allocations being much higher because of the value that hedge funds offer to smooth that return as clients draw down their money. So there's no limit for post-retirement or voluntary savings when you have exposure to hedge funds. Some list platforms do impose some type of limits. That's normally when there's a model portfolio. These days, there's model portfolios for hedge funds, and it hasn't come to the point where there might be model portfolio necessarily for pre-retirement money versus post-retirement money. So then if you invest in a model hedge fund portfolio in post-retirement money, they sometimes still have the pre-retirement limits within that. So just be aware of that. You might want to top that up with direct hedge fund exposure if the model portfolio has got these Reg 28 limits. Board Notice 90 currently still disallows long-only collective investment schemes to invest in hedge funds, unfortunately, but it is being reviewed. So very soon we expect that normal unit trusts will be allowed to allocate to retail hedge funds. We just don't know what limit. The initial proposal was for 10%, similar to Regulation 28, but the feedback has been given to the FSCA and National Treasury to say that is not sufficient. If your most conservative portfolio, a Reg 28 portfolio, should be a 10% limit, then surely 100% equity funds and other types of flexible funds should be allowed a much higher allocation to retail hedge funds. The other regulatory event that happened is at the end of 2024, National Treasury released a regrettable paper on the taxation of collective investment schemes. I call it regrettable because it was quite shocking, and it was not just bad for hedge funds. A lot of people miss this, that what they said is, if you don't hold something for longer than, I think, whether it was 1 or 3 years, then it will be deemed to be income. And I can tell you, there are a lot of traditional long-only unit trusts that trade very actively. So if this paper was to become policy, you would have been taxed on your traditional unit trusts, potentially more than you would have been taxed on your retail hedge funds because of how active some traditional long-only managers are. Thankfully, the industry gave strong and valuable feedback. So if you look at the latest comments in the 2026 budget, it's much more logical. The current proposal seems to be that it's back to being deemed capital for retail hedge funds and traditional long-only unit trusts, which is positive and puts us, again, potentially on an equal footing to offshore UCITS funds. But there's still a question mark about QIFs. So we'll see what happens. There's a regulatory review about alternative funds happening. So retail hedge funds stay as collective investment schemes. All collective investment schemes get greater tax certainty, and QIFs will be reviewed. A little bit about Protea before I get into how hedge funds have performed in the market turmoil. We are 6 people, each specializing in our role. We use a lot of automation in our both operations side and investment side. We have 4 hedge funds. 2 of them are retail hedge funds, the Protea South Africa Retail Hedge Fund, the Protea Global Retail Hedge Fund, and 2 QIFs, Protea Worldwide Flexible and Protea International, for those who want to invest in dollars, pounds, or euros. We follow a quantamental investment process. And I can also mention that 2 weeks ago, we launched an actively managed certificate, the Worldwide Qualified Fund, which is roughly 50-50, our 2 RIFs, now also has a AMC listed on the JSE, and you can buy it now in a brokerage account. Instead of monthly trading, it's now available for any day of the week. It's got a 200% limit, and you can contact us. The market maker is UBS. We'll put you in touch with them, and it's just another way to access our hedge funds. You can buy the retail hedge funds on list platforms, or you can use a brokerage account and buy the the actively managed certificate, which mirrors our worldwide flexible long-short hedge fund. Like I said, our two RIFs together form the worldwide flexible QIF, so a very similar return profile, whether invested in the QIF or the two RIFs in a 50-50 allocation. Some others have also shown these types of slides. If you take the 10 worst months of the JSE, since we started our worldwide QIF almost 10 years ago, and you see what our funds did, in the 10 worst funds, our funds protected on the downside. That's compared to the JSE. Similar picture when compared to the FTSE developed world. When you have sharp drawdowns, our funds have sometimes actually been up in these sharp drawdown periods, which really shows that we cushion the downside. So for our qualified investor hedge fund, our flagship fund, our worst month since we started 10 years ago, 4.6%. Our lowest rolling 12-month return, -7.5%. And our largest cumulative drawdown, the longest period from a previous high to the low point, only 8.2%. So from a risk perspective, our risk profile is a lot lower risk than equity markets. But we still managed to capture the upside, and this is the important point. So much less downside with equity-like upside. This is exactly what we believe a risk-diversifying hedge fund should do. So let's look at the recent market turmoil. How have hedge funds fared? This is based on daily data from the 1st of March to the latest available when this presentation was prepared, which is 19 March, last week. I had a look this morning. It's a very similar picture this morning. At that point in time, the top 40 was down 15%. Up to this morning, it was down 11%. LB was down 6%. The return-enhancing hedge funds are down similar to the equity market. The active extension strategies have been hit, but that is as expected because, again, they've got 100% equity exposure at most times, while the risk-diversifying hedge funds have been down much less than either the top 40 or the LB. Some have even been up during this time, with the market-neutral and fixed income strategies holding up particularly well. So to show it graphically, the black line is the all-share or the top 40 index, and the red and orange lines are two well-known active extension strategies. So you can see very similar performance in down markets. It's important to mention that these two hedge funds in particular, I don't name the names, but they had very good years last year. The one did a net return of over 50%. The other one did more than 40%. So it's not unexpected that they fell similar to markets, because when they went up last year, they went up even more than markets, which is what their strategy is all about. The other hedge fund strategies, whether it's market neutral, fixed income, multi-strategy, or then our two Protea funds, which is the pink and purple I put in here as well, were down only a little bit. We're talking about 2, maybe 3%. Well, the LB was down, like I said, more than 5%. Some multi-strategy funds down, say, 5%, but the rest much better. And if you look, there was a market neutral fund, one of the major ones, that was actually up, as well as a fixed income fund that was also up month to date. All these figures come from Bloomberg because hedge funds are daily dealing these days. You can get daily pricing. How to access our hedge funds? You can invest directly. You fill out a form. You contact the management company or Manco. They work with their administrator, which is Apex, who are offering this webcast. Financial advisors can also fill out a form for a trailing commission if your clients have invested directly, or our retail hedge funds on all the major list platforms. So you should be very comfortable to pick our funds. You might need to ask them if they're not on the open list of your list platform to allow your advisor practice access to our hedge funds, and you can access them in that way. We are also part of quite a few model portfolios, so you might have indirect exposure to the Protea hedge funds you mightn't even be aware about. And then our multi-domiciled Protea International Hedge Fund is Section 65 approved, and that's for investors who want to invest in euros, pounds, or dollars. It also is on 3 platforms: Quido, Momentum Wealth, and Swissquote. So reach out to us if you want to invest in hedge funds that are domiciled offshore. Here are our contact details if you want to get in touch, and the disclaimer. And that's it from my side.
Thank you very much, Jean-Pierre. I always feel you give a very clear explanation of all the important aspects of hedge funds. So thanks for articulating that so clearly. Just a question on your funds, actually the access points. Your worldwide fund, which you pitch as the best of your local and your global fund, is a QIF with a R1 million minimum subscription, but you also have the managed certificate, and I'm actually not sure. Does that come with the similar minimum subscription? How does a managed certificate work in terms of subscription amount? Or,
So,
it's daily dealing through your stockbroker, but in what denominations can you buy it?
yes. So, as you correctly say, the Protea Worldwide Flexible QIF has got a R1 million minimum. It only trades monthly, and it has got these wider risk parameters of having up to 400% gross exposure limit. What we've seen is we've rarely gone above the 200% limit. So we realized that strategy can fit in a risk wrapper. And that's why we also say if you invest 50-50 in our two RIFs, you get the same as the worldwide QIF. But for a lot of investors, they still wanted a product that was on the box, the worldwide flexible strategy. So we launched this actively managed certificate 2 weeks ago with UBS being the market maker, and it effectively has no minimum. UBS are on the bid and the offer all the time. It's a very small amount of shares that they show on the bid and offer. So that's why we say if anyone is interested to buy into this AMC, please contact us. We'll put you in touch with UBS, and they can make you then a price at the higher volume of shares that you want. But we've actually seen this last week, people buying one share at a time, which is about 100 Rand to invest in the fund. So it has very low minimums, but you pay brokerage fees. So you probably want to still, I would say, have at least 10,000 Rand when you invest into this worldwide flexible AMC.
Thank you. That's valuable information to have, I think. And then I have to ask you, because I know hedge fund managers sometimes keep their cards close to their chests, and you've chosen to speak quite generically, I suppose, in this presentation. But give us a minute of your macro views, or if not macro views, tell us what the things are that worries you the most at the moment and what excites you the most.
So our quantamental process being a man plus machine process, so it's mostly my human brain plus algorithms we run on financial statements to get a very objective view about fair value. Our decisions is based on valuation. So we generally short assets that are expensive, and we generally buy assets that are cheap. Coming into March, we had short positions in gold miners. We thought they were very expensive. And we had long exposure in South African industrial companies and financial companies. Internationally, we had longs in European banks, some semiconductor equipment exposure, and short some quite frothy valuation companies in the US. When all of this started, we did not change our portfolio as much. And we were trading quite actively when we launched the AMC 2 weeks ago. For the rest of the days, not very active, but yesterday was the first day we were quite active. And coming into this month, we had relatively low net exposure. So yesterday we were significant buyers. We were buyers of South African Inc. type stocks. We were buyers of South African banks. We have not covered our gold mining shorts yet. We bought software names, specific software names in the US. And where we are right now is our net is quite a bit higher than what it was a week ago. So I don't have a crystal ball. I don't have a macro view. But when the prices change significantly, as it has in this month, that means our algorithms, our quants, together with me as more qualitative assessment, see new opportunities. And it's because these prices have moved a lot that there are opportunities of shares, high quality shares that have become cheap. We've been buyers of those. We still have some shorts, but we're looking forward to some opportunities to short some companies that get too expensive also as these shares move along.
Thank you very much. That's valuable information. Thanks for the presentation, JP. Really good and enjoyable. Andre, can you maybe just come back online? I just want to ask you a few questions about your fund. You gave a lot of kind of views information and macro information, but can you just clarify your long-short hedge fund? Is that a fund that invests both in South Africa and globally? It sounds like that. So if that is the case, then the question is, are there kind of a strategic benchmark for the SA versus global exposure, or is it a case of you can invest anywhere and you do actually kind of move it quite extremely between the two investment areas?
Yeah, thanks, Pierre. So it is a RIF, and there is the 45% offshore max allocation that we do have. But I mean, besides for that, we do invest everywhere where we see fit. We do not force any shorts in the fund. We only short when it makes sense, even though it's a long short fund. I mean, I don't go out today and say I must short something because I don't have enough shorts in the portfolio. So we do have a strict process in terms of sizing positions, but we're not restricted into where in the globe we invest. We do invest where we think we're going to get the best excess returns for our investors. And as the previous speakers has mentioned, there is starting to be some nice opportunities globally and locally as asset prices are coming down.
You spoke about the importance of China on the rare earth side, and you also mentioned, as many of us know, that China have actually have held up quite well this month so far. Do you have any specific China direct or indirect exposure in the fund?
Yeah, no, Pierre, regrettably, we've had Naspers process for a while now. But we do have the Chinese onshore index because it's very difficult to trade the onshore in the actual underlyings, and once you go onshore, it's very difficult to evaluate the different stocks in the Chinese market because there's a lot of the accounting is just a bit different. So we do take a view there, and I've actually sold JD.com yesterday night. There came out some news of increasing regulations, which is actually good for JD.com. So I've used the opportunity to sell JD.com. So the only direct or indirect exposure at the moment is Naspers process and the onshore index, which is quite sizable in our globe, in our portfolio.
Thank you very much for that. Thank you very much, gentlemen. I think we are at time, or a few minutes over time, so I think I'm going to end it there. If there's any questions from the audience that we didn't get to, we'll circulate it to you for answers. So thank you, Andre, thank you, John, Pierre, and Johan. It was really insightful presentations, and I think the underlying theme or kind of truism that the audience would have gotten from what we covered today was that hedge funds is not a homogeneous asset class, that you must really have a good handle on the fund that you're exposed to and its characteristics, and that it is possible to build a very nice, diversified fund of hedge funds or portfolio of hedge funds or blend of hedge funds in your portfolio that can be, on the one hand, some of them return enhancing and more aggressive for a certain part of your risk budget, and then also risk mitigating, as was pointed out. So it is an exciting space for us as multi-managers and asset consultants. As Eugene mentioned, we also manage some hedge fund model portfolios for some of our clients. And as John Pierre mentioned, that we are all optimistic and look forward to the day that we can include it in CIS funds, because that will really give us an additional lever, well, a set of additional levers that we can pull and use in our CIS products that will make a meaningful contribution to the risk-adjusted returns. So thank you very much to the three panel members. It was really good. Thanks for your time. Thanks for the audience for joining us, and please join us again at the following hedge fund session that we'll have sometime in the near future, but also next Wednesday for the next boutiques on Wednesdays when we return to the long-only world. And your regular host, Eugene Brock, I'm sure will be back for that. Thank you, everyone, and thank you, Eugene, for opening, and for Apex and FundRock for having us to facilitate it, and for the audience. Enjoy your day.